Welcome to today's episode for PACE Property Investment and Tax Strategies Group. In this episode, we're going to talk about the ownership structures for the investment properties. And here, Raj is joining from Safari Accounting and me, Bimal Sekho from Auto SMSF. So let's start on our today's episode with the ownership structures for investment properties. Welcome, Raj. So tell me, what are the property ownership structures? What actually mean by property ownership structure, and how many are available?
Yeah, so this is actually a good topic because there are so many people who really don't know about all the structures. They simply just know one or two and they simply just go with that one. So there are kind of like three, four, five structures are available. There are some are very simple. So we'll start with the simple one to just explain and let our audience know.
Yep.
First one is the single ownership. Single ownership is the one very simple structure where the owner is one owner only and 100% of income and expenses goes to that particular owner.
Yeah, like me going and buying the property.
Yeah, it's just a single one person. It's not joined with anybody else. So everything, whether it's a profit or loss or anything, it just belongs to one person really.
Okay.
Yep. And second one comes the joint ownership. So joint ownership is the one where actually you share the ownership equally with two person, 50-50. And it's just like whatever percentage, which is 50-50, all your income and expense, everything will be shared in the same percentage. So it can't you can't decide on to any of the percentage in this one.
Yep. So it's equally. So if it's two people, it's 50-50. If it's three people, it's 1/3, and as it goes.
Yeah, as it goes. So it can be more people, but usually it's
always
50-50
equal percentage.
Equal, it's just the example that is equal, but it can be more than two people.
Yep. Okay. And then we got the tenant in common, I think, in this one.
Yes, that's right. So tenant in common is the one where actually you can decide onto the percentage. It's different to the joint ownership where, as we said, it should be definitely equally distributed or shared. But in the tenant in common, you can decide on any percentage. It could be 40-60, could be 90-10%, or could be 50-50 as well. You can decide onto that too. And whatever you decide, you just stick to that one.
Yep. And I think the big difference, other than the tax and the percentage between the joint tenants and jointly owned or tenant in common, is that when it's a jointly owned, when one person passed away, the ownership actually automatically goes to the surviving partners.
Yes, that's right.
The owners. Whereas when it's a tenant in common, it actually goes to the estate of the person who passed away, not to the surviving owners. So it's a very good estate planning in that way, and especially when you are owning the property with unrelated members, with your friends or siblings or someone where you don't want the ownership to go to the other person. So
then you can choose this one. And this is really good one to know people, because most of the people doesn't know about this one.
That's the thing. So many people we come across, and two brothers or brother and sister, they own the properties, and then they don't realize they're actually owning that jointly. And if one passes away, it actually goes to the other one, and their family or kids may not end up having anything. So that's a very good point to know.
They only know when the time comes, but at that point you're very late.
Exactly. That's right. It's a very good point there. Yep. And I think there's another structure which is not very popular, is the partnership, which is very similar to the tenant in common, but it actually, where the income just goes to the partnership under the partnership tax return. Am I right?
Yes, that's right. The thing is, in that one, you have to create the partnership in there, and there is extra expense for that. So that's why people really don't want to go having the same kind of structure and paying extra. They don't like to go for that. So that's why it's a very uncommon one.
With someone, there may be some circumstances where actually that structure suits you. So I think we highly recommend to talk to your advisor or the accountant to see whether actually that structure is better for you compared to going into tenant in common, because everyone's circumstances are different.
Yes, that's right. Everyone
Yeah.
is different, so it depends on person to person what's their
Yeah.
circumstances are. That's right.
Exactly.
Yeah.
So these are the common and less expensive structures with a very minimal cost. Then we come to the more complex structures, which are like companies, trusts, and super funds. So let's start with the company. So these differ from the other structures.
Yeah, so company is the one, definitely you have to create a company in there. It has the annual expenses associated with that. And all your income and expenses, whatever, that stays in the company, and you pay the company tax, flat rate, transfers to anyone else. You just pay the company rate there.
So good with the
Yeah.
higher income earners, instead of paying 47%,
Yeah.
the company is only paying 25% tax. Yeah.
That's true. That's true. But if you're like smaller, then again you need to decide on to based on your situation, your financial numbers and everything. You can see what is in your benefit, whether to go for company or any other structure.
Yeah, but I think we don't recommend that property in a company, because of one of the big disadvantage is that you won't get 50% discount.
That's true. That's true. So that's the big one, which most of the people, they never thought and never know about this. They just say, oh, if there is CGT, there is 50% discount available. But that's not the case in company.
The companies don't get that. No. So
That's
yes,
right.
let's leave that one. We don't want to go that way. So the
Yeah,
next one
so keep
then
it
comes
aside.
so next one that comes is the trust, with the trustee company in majority of the cases. Yep.
Yes.
So
So in this structure, you create the trust and the trustee company. Most of the time, trustee is the company. You can choose to be individual trustee, but mostly we go with the company to be as a trustee.
Advisable.
That's advisable, and then your property will be under the trust name, not under your name. And then all your income and expenses will be treated under the trust. And then if there is income, then that will goes to the beneficiary as per your trustee. And if in case there are losses into the trust, then that will stay in the trust and get forward to the future years, and it can be it will offset against your future income then.
So it's a good structure where actually for the asset protection. So if you are in a business where actually you are on a high risk area, so and you want to protect your assets, you can have that in a trust structure and with a corporate trustee there. And that way you can actually distribute if there's any income to the beneficiaries, and if a loss is, that can stay there.
They stay there, and you can just utilize in the future then.
Exactly. That's right. And I think that's very good for, especially when it's a family trust or discretionary trust, for the capital gain purposes, because you can actually plan and talk to an accountant when to sell the property, so that if any capital gain you make at that time and you have good number of beneficiaries with a low income, you may end up paying very, very little tax in that scenario. But
that's true. That's true. So that's
very
why
good
people
for the tax strategies.
Yes, it's good for the tax strategy. So that's why people like to go for the trust, not for the company.
But saying that, there are always, with every structure, the more the complex the structure, the higher the what we say cost involved in that one. So if you're going for company or trust structures, obviously high admin costs, high accounting costs involved there compared to just owning yourself. And I think the other one is which is more of the land tax, because in some of the states, if the property is owned under a trust, the land tax surcharge is applied.
Whereas while that's not case in the
individuals and the other structures. So so be mindful of those type of costs as well. But it again, cost versus benefit. Sometimes the benefits are higher, even the cost is higher, but benefits are much higher compared to the other ones. So always talk to your accountant. If you don't have any, talk to us, and we can actually explain you guys which structure is better for you.
And this is I think is here to mention that these all structures need to be done before you buy the property. Once you purchase the property, you can't really change the structure or move from trust to company or individual or anything. Once it's
Have to
done,
pay
it's
the
done.
stamp duty, yeah.
Yeah, that's true.
And the capital gain tax because you are changing the ownership. Very, very, very valid and good point, Raj. Yeah, because
Yep.
it's something you need to talk to your advisor before actually committing or signing the contract there. So yeah, highly
Yes, that's
recommend
right.
to talk to your advisors before actually doing that. Now we
Yeah.
come to the last
Now,
structure.
yeah,
Yep.
the last one, which is these days getting popular, that is the self-managed super fund. And
one is very different compared to the other structures because the main difference between the self-managed super fund is you can't actually use any of the profits until you retire. So tax law works the same in that way. The tax rates are different. So if you're buying the property in a self-managed super fund, income expense is similar way. Any profits that you make stays in the super fund like the companies or the trust, but it gets taxed at 15% instead of
that's right.
at the marginal rate.
Marginal rate, yeah.
Yep. And when you actually sell the property, again, the capital gain tax is different. So it's not 50% discount, it's 33% discount and then tax at 15%, which comes to around 10% in tax when it's in super fund in accumulation mode. But once you retire and you convert the whole fund into pension phase, then there's no tax to pay in the super fund. So that's very, very big advantage. If the reason to buy the property is for your retirement, but if the property that you are purchasing are for investment to utilize the income before your retirement, yes, use the other structures, the one that Raj mentioned before. So
now, Vimal, as we talk about the investment, so when you're buying property in the super fund, can you rent it out to your family members?
No. That's another disadvantage of buying property in the super fund. Valid point, Raj.
Yeah.
So if we are buying the property in individual names, buying the property in trust, companies, no restrictions who you are renting to. You can even live in the property yourself in the property. But super fund got that restriction. So super fund, if it's a residential property, you can't actually live, you can't actually rent it out to your to your family, relative, or any associate. So it's only the commercial property that you can actually rent it to yourself or your business, but not the residential one. Yep. So that's another big restriction there. Yep.
Yeah.
So so I think we have covered most of the structures here. And
yes, I think we did.
Yep. And I think to our audience, I would say just talk to your accountants, talk to your advisors before you actually decide which structure is better. So yes, there's a lot of information online. You can leave us in the comments as well if you need more help or more information on any of the particular topic. But look for our other episodes with Sam, Tushari, and Raj and me, and let us know in comments what other topics you would like to discuss. Thanks for joining us.
Thank you.